Hello, everyone. Thank you for tuning into the call. Jack and I just finished our analysis of your portfolios, and we just wanted to highlight our findings and some of the risks that we see could play out potentially in 2025. One of the biggest concerns that we have in managing your investments this year is the uncertainty created by the new administration in the United States, President Trump. There's no question that political dynamics in the US, but also globally, are starting to shift. But one of the things that we wanted to make sure that we highlight to you is that our investment philosophy remains focused on the fundamentals of well-run businesses. Historically, in our experience, over time, strong companies find ways to thrive regardless of the political or economic landscape. So after we've conducted a thorough analysis, we believe there are some adjustments that we need to make in the portfolio just to help manage some of the risks that could play out in 2025. Specifically, the United States appears to be one of the more promising investment locations. We feel that the new administration's emphasis on reshoring, meaning bringing the manufacturing back into the United States, reducing corporate taxes, limiting government regulation, all these sort of factors can help translate to increased revenue potential for US-based companies. In addition, US interest rates are also looking to stay higher for longer, especially compared to Canada. And this increase, or the higher interest rate, has the potential to increase the value of US currency against others. Your portfolio has benefited from a significant exposure to US businesses over the last number of years. And quite frankly, we don't expect that trend to change anytime soon. Going back to the administration in the US, it appears that their internal focus is going to be on the US. And so our concern is we see greater amounts of uncertainty in regions like Europe and Asia. Especially when we start to think of things like the challenges posed by the global trade dynamics, while also looking at the aging population in countries like China and Germany.
So for these reasons, we've sold the exchange-traded fund invested into Europe and taken the proceeds and moved it into the tactical equity part of the portfolio. We also decided to simplify the fixed income part of your holdings. We've reduced the weight of the Manulife preferred share, and we've switched the bond funds into a corporate value bond fund, which we think will add value for you, or add returns. We also have exposure into real assets. These behave differently than the other part of the equity holdings in your portfolio. They help protect against inflation and give you exposure into things like real estate, warehouses, ports, server farms, and so on and so forth. Part of our investment process is to periodically pare back those assets or those investments that have grown faster than the others and move money from them into those other ones that we still think have potential and add diversification to your portfolio. We're not going to go into the changes we've made specifically in this recording, but certainly you're welcome to give us a call if you have any questions. We are going to go through the changes we've made in the tactical asset part of the portfolio. This is the growth engine of your holdings. We've had significant exposure into technology here because we see technology as a driver of positive change in our present economy and society. There's been a lot of media noise on artificial intelligence lately. We see adoption of technology in the past has usually driven down costs and increased take-up of services and new products. And we don't see any change for AI in the near term. So we're not concerned about a lot of this noise that's happening right now. Twice a year, we conduct a major review of the holdings in your portfolio, look for new ideas, new businesses that we can tuck into your accounts. We look for businesses with increasing revenue, low debt, and a number of other fundamental strengths. Ideally, we're going to hold these businesses for a long period of time, but as conditions change or other better ideas come along, we will make a change. Thus, we decided to sell out of the First Trust NASDAQ Technology ETF and replace it with a robotics company in the healthcare sector. This is Intuitive Surgical, ticker is ISRG. They make machines that help surgeons perform minimally invasive surgeries, allowing faster recovery time for patients. From knee and hip replacements to cataract surgeries and other procedures, we see a growing demand as people like myself get over age 60. I just had my cataracts done, so we think it's a good growing business. With the money from the sale of the European ETF, we decided to add a smaller company than we had in the past, diversify into a smaller cap. We added Applied Industrial Technologies, or ticker AIT. This is a 100-year-old company that provides equipment and engineering services primarily to the manufacturing industry. They're well positioned to benefit from the trend to reshore businesses and manufacturing back into North America. That concludes our call. We hope you enjoyed it. Please call us if you have more questions.